All right, welcome to the Explainer. So there's a new tax on capital gains coming to Belgium. And let's be clear, it's set to impact pretty much every investor in the country. It all kicks in on January 1st, 2026, and it's really going to change the game for how your profits on stocks, crypto, and other assets are treated.
Now, this new law is a bit of a tricky one. It has a lot of moving parts. So to make sense of it all, we're going to treat it like an onion. We're going to peel it back one layer at a time to get to the simple truths at its core. So ready? Let's get peeling.
Okay, so here's the game plan. We'll start with the real basics, who's affected and what's being taxed. Then we'll look at what actually triggers the tax. After that, we'll get into the big one, how much you'll actually pay, before we cover how it's collected, and finally, what your next step should be.
All right, let's peel back that first layer. This is the foundation. So who's on the hook for this, and what kind of assets are we even talking about here?
Well, the answer is pretty straightforward. If you're an individual, a person, and you pay your income taxes in Belgium, yep, this new law is for you. Plain and simple.
And let me tell you, the scope here is wide. It's broken down into 4 main categories. You've got pretty much all financial instruments. Think stocks, bonds, ETFs, the usual suspects. Then there are popular savings insurance products like Branch 21 and 23. It also covers all forms of crypto assets, and they get really specific about crypto in the law. And even things like foreign currencies and investment gold.
Okay, but it's not all doom and gloom. There's some good news here. Your standard Belgian retirement saving plans, things like pension funds and group insurances, what people often call the second and third pillars, they are explicitly left out of this. So you can breathe a sigh of relief. Your dedicated long-term retirement accounts are safe. All right, on to the next layer of our onion. Let's look at what actually triggers this tax. You see, it's not just about owning the assets. It's a specific action you take that creates what's called a taxable event. So the key here is a fancy legal term, transfer under onerous title. All that really means, in plain English, is a sale. As long as you just buy your assets and hold on to them, you generally don't have to worry. So the general rule is simple. If you don't sell, you don't pay. Simple as that. But of course, there are always a few wrinkles. For instance, if you gift an asset to your child, no tax is due right then. But, and this is important, that future tax bill gets passed on to them. But the really big one you need to know about is the exit tax. If you decide to move and are no longer a tax resident in Belgium, the law treats it as if you sold your entire portfolio, right then and there. That triggers a tax on all your unrealized gains. Okay, now we're getting to the core of the onion. This is the part everyone's been waiting for. The big question on every investor's mind, how much? How much are we actually going to have to pay? Okay, to understand this, you have to get your head around this concept they're calling the FIFO moment. It happens on December 31st, 2025. So let's imagine you bought some shares back in 2022 for 100 euros. On that last day of 2025, your broker takes a snapshot, a photo of what your portfolio is worth. Let's say those shares are now valued at 150 euros. Then, fast forward to 2029, and you sell them for 170.
And this, right here, is probably the single most important thing to understand. Any profit your portfolio made before that January 1st, 2026 date is completely safe. In our example, that's a 50 euro gain. That historical gain, it's yours to keep, forever, untaxed.
So how does the math actually work? It's pretty simple, actually. You only pay tax on the profit you make after that photo moment. The tax is just on the difference between your sale price, 170 euros, and the value on December 31st, 2025, which was 150. So your taxable gain is just 20 euros. That's it.
Now, here's another really interesting part, the annual exemption. Every single year, each person gets a 10,000 euro tax-free allowance on their net capital gains. And for a married couple filing together, that doubles to 20,000 euros, which is a pretty nice perk. Okay, a few more quick rules you've got to keep in mind. The good news is you can subtract your losses from your gains within the same year. The tax rate on whatever is left over is a flat 10%. The not so good news is that you can't deduct transaction costs, like broker fees. And one last thing. For the math, you have to use the first-in, first-out method, which just means the tax office assumes you're always selling your oldest shares first. Okay, so we know what's taxed and how much, but how do you actually pay it? This is where the practical side comes in, and this is where your choice of broker becomes, well, really important. Okay, path number 1. You use a Belgian broker. This is by far the simplest route. By default, they do all the heavy lifting. They do the FIFO calculations, they would hold the 10% tax for you when you sell at a profit. You might still want to file a tax return to claim your exemptions or your losses, but it's optional. Now, if you're with a foreign broker, it's a totally different story. The whole thing, the math, the filing, the payment, it's all on you.
Now, there's a little wrinkle with Belgian brokers. They offer something called an opt-out choice. You can basically tell them, hey, don't withhold the tax on every sale. This gives you better cash flow throughout the year. But, and it's a big but, if you choose this, you are required to declare all of your transactions on your tax return. So it's a trade-off, better cash flow now, but more paperwork later.
All right, we've peeled back every single layer of this onion. We've gone from the basics to the nitty-gritty, so what do you do with all this information? What does this mean for you as an investor right now?
You know, the best advice I've seen on this echoes the legendary investor Jack Bogle, who famously said, "Don't do something, just stand there." For now, don't panic. Let me be super clear here. There is zero benefit to selling everything before the end of 2025 to try and dodge this tax. In fact, doing that would probably just cost you a bunch in unnecessary fees.
So let's just quickly recap the big takeaways here. First, your past gains, your historical gains, they're safe. Second, that €10,000 annual exemption is a really powerful tool for managing your taxes. Third, who you bank with, your choice of broker, is going to have a huge impact on your paperwork. And finally, the bottom line, even with this new tax, investing in Belgium is still a fantastic way to build wealth.
So, look, this new law, it's not the end of investing in Belgium, not at all. It's just a change in the rules of the game. It shifts the landscape for every single investor. And that leaves one really important question that only you can answer for your own financial future. How are you going to adapt?